Good day, fellow investors. I've recently taken a trip to Switzerland, to Zurich, for the long-term investment fund 5th Natural Resources Day. It's a day of discussing commodities with various presenters from EOG, from high yield funds, from Bernstein. A lot of very interesting presentations that I will share with you also here on the YouTube channel. But today the goal is to share what they shared and my view and the investment thesis around copper. By the end of this video, you should be able to understand the risk and reward of investing in copper in general, and at this point in time, what best investment strategy fits you from that risk and reward perspective, what are the expected returns, how to invest, what offers more upside, more downside, and less upside, and of course less downside. And that should all trickle down into a technique, when to buy, when to sell, how to fit these miners that produce an essential metal for whatever comes next, electrification and everything, how we live, and how to take advantage of the situation, the volatility in the market, when and to make money, of course, as investors. There are two presentations that I will share from Marcos Hernandez, Chief Investment Officer of the Long-Term Investment Fund. You'll have the link in the description below to their page. I have no affiliate. They just share good research that's complementary to what I do, to what we do on this channel, so they're happy if I share it. You get great, extremely valuable content, because for these presentations you have to pay thousands of dollars to the various McKinseys, and I get good content, great research, so it's a win-win-win for all. And there was also Bob Brackett from Bernstein giving a presentation on outlook of oil and metals, how to invest. I'll focus here on copper, and then oil will do in another video. If you enjoy this, if you like the quality, the value given here, please smash that like button and consider subscribing, as there will be plenty more research shared here on the channel. Now, let's start with the key factors for investing in copper and copper mining that I think are relevant. So this is me, Sven Karlin. The first one is that copper is cyclical. It depends on productions, investments, the macroeconomic situation, and also speculators. If you look at a normal cyclical commodity, you can see that high prices that are currently there and also have been in the past lead to higher investments that then lead to oversupply and consequently to lower prices at some point in time. Low prices lead to low investments, undersupply, and extremely high prices at some point in time that again lead to low prices that again lead to high prices. That is the typical copper investment cycle. Of course, this is not precise. There are recessions, macroeconomic, increased demand by electric vehicles maybe in the future, but one thing to look is also recessions, and how long will a recession be reflected in the copper price depends on inventories. So over the last years, copper inventories with COVID and everything have been on the decline, which means that even if there is a recession, as soon as some copper producers put their minds on care and maintenance, the price might spike up sooner rather than later. If you have lots of inventories, then it's often the opposite. But copper prices also depend on macro factors, of course, recession, long-lasting global recession, doom and gloom, very bad for copper miners. Exuberant times, investments, renewables, infrastructure, everything very good for copper. The second factor to watch is that cash cost is king when it comes to production and also investments, depending on what is the margin of safety you want. When you don't make money, cash, when having a mine, you stop producing. That lowers supply and balances the market. As you can see here on the copper price, where cash costs are those that really matter for miners, they want to make money no matter the environment, to pay loans, to pay whatever. You can see that at the bottom, usually copper bottoms when it hits the 90th percentile of cash costs, so or close to that. If the copper price hits that, the marginal producers are eliminated, and that brings again stability to the market, and then we have these upsides again. Of course, this is the most conservative investment strategy with the biggest margin of safety because the price won't stay this low for longer. Of course, a few months, 6 months, depending on the issues there, etc. But sooner or later it should go up. So that's a key factor to watch and also to understand the risk. Current cash costs are 2.5, around 2.5 for the 90th percentile, 3.3 for the current price of copper. So there is still a little bit room for lower, albeit it might never reach that number and just spike up on the bullish thesis that we'll discuss later. Now, there is also something extremely important when it comes to copper. There is, yes, commercial demand for copper, but speculators are extremely active as they know how much commercial demand will there be. They try to buy it, sell it to you later, or short it so that they make money on that. And there is a huge chunk of speculators in the copper market that also impacts the price. If you look at this, the white line is speculators, the yellow line is commercial demand industry, and the orange red line is the copper price. Currently, we have seen speculators lowering their positions, actually negative, being short, and we have seen commercials growing. Usually that leads to higher copper prices for a little moment, but that is something that we have seen already earlier, and then there is the decline again if you look at these discrepancies over time. So depending on how you look at it or for how long you look at it, then there are different inputs, but keep in mind that these speculators that are now selling, those are the ones that are pushing this stock price or copper price lower. So that is something also to know. It's not just the industry, it's also in the short term a lot of speculators that creates opportunities for the patient investor looking for less risk and higher reward. Then when it comes to specific miners, you have to look at, of course, the production cost for that specific miner, because that's a huge difference and has a huge impact on a stock price. For example, if we have two miners and copper prices are at 3 and then go to 4, when, let's say, a high production cost miner that has 3 cash cost of production per pound and the copper price is 3.1, the miner makes 10 cents profit. If there is a miner that has byproducts and has no production costs, the profit at $3 is $3 or 3.1. Now, if the price goes to 4, this miner now increases the profit from 10 cents to $1, which is a 10x, but this miner increases just 1.33 times or 43%. That's a huge difference, and that has a huge impact on copper miners. So Capstone Copper, for example, cash production costs of $221 in 2021, which means that they weren't making any money here. When copper prices spiked up, the stock price went from 40 cents to almost $8. So that's almost a 20 bagger. Of course, as copper prices started declining again, it goes down like a rock. That is the risk and reward depending on the production cost of a specific miner. Something else to watch is life of mine. You have a mine, production and everything, but for how many years will you be able to mine that asset, because copper is a depleting asset business. And you can see here the largest copper reserves per company: Southern Copper, BHP, Freeport, Glencore, Anglo American, First Quantum, Rio Tinto. So how many million tons in reserves? And then you have to see, okay, how long will they be able to mine the copper they have at a sustainable pace. Of course, the longer the life of mine is, I have a feeling there is more value, because the market doesn't care if there is 9 years of life of mine or 20. If there is 3, 5, then it's calculated by calculating the price of copper and how much cash will that mine produce till end of production. But if it's longer term, the market, of course, with discount rates, it is not that relevant into current models, but I always like to get that value for free if possible with longer mine production lives. Then we have something extremely important, which is jurisdiction. Because mining, it's not an easy business and nobody wants it in their backyard. But everybody wants the copper, and especially renewables. So if you have just one mine or you're mining in Chile, raising the copper tax can just slash into your profits. In Africa, the rules of mining are changed constantly. Governments can do whatever, and that is always an issue for miners. The answer is, of course, diversification from an asset-based perspective, from a country-based perspective, because also from an asset base, this can happen. So you suddenly lose half of your mine. Pause the video and watch the picture what can happen. This is the Bingham mine, and if that happens and you have only one asset, you lose all your money. So that's something. On diversification, you can diversify, lowering your risk, but then also your reward might be lower because you're not buying just the best asset that it is there. So that's more of a bottom-up approach, but to be considered when looking at miners. Of course, financial position also, because if you have that, when the cycle reverts, you are in trouble. This is Freeport-McMoran's debt cycle. They invested in oil and things like that, feeling very powerful when copper prices were high. Then that reverted, and you can see here the extreme volatility with the stock price and of course related to debt. They still have significant debt now, and you can see also the volatility of the stock price now at 26. I think it reached 50 just a few months ago. So these will be just some of the factors that are extremely important when it comes to investing in copper, and let's now dig into the presentations. The first presentation is from Marcos Hernandez, Chief Investment Officer of the Long-Term Investing Fund, and they have done a great job at investing in resources, good businesses over time. They have outperformed the market for the last, I think, 15, 20 years. They did a great job, of course, in the last 3 years. And it's always nice to see and read into an investment thesis by an investment manager. So the first step is, of course, that for electrification, for renewables, for infrastructure, for rebuilding the world, onshoring, doing everything, you need the copper for the electrical grid, for this, for that. And there are extreme capex needs in Europe, in the US. And if that hits the market from a demand perspective, then of course more copper means more demand for copper, which is always a positive structural tailwind. And also Buffett always says that if you invest with the positive tailwind, then even if you make mistakes, that tailwind might save you from losing money and making mistakes. They expect that copper demand will be 30% higher over the next 10 years, and the stability of copper, that demand, that increased certainty, and the situation also with supply that we'll discuss in a moment, makes copper one of the easiest way for retail investors to play these commodity cycles, protection from inflation and everything, but also from a risk-adjusted position, copper looks like one of the best commodity investment bets out there. There is huge demand for green metals, lithium, graphite, nickel, cobalt, copper. The problem with lithium is that recycling will be a huge issue for investors, and it's easier to develop a lithium project than a copper project. Graphite is also difficult to invest. Nickel might be something we might research, and cobalt it's also very difficult to invest in, which leaves copper for us retail investors. Copper demand is expected to constantly grow over the next decade and then beyond based on infrastructure, electric vehicles, storage, wind, solar, renewables, all the ESG and zero emission targets that we have. If that is developed and those targets are going to be reached, you need 5 million tons of demand for copper on top of the standard demand based on global GDP. And that increase in demand is huge. You can see here the chart, especially high demand from electrical vehicles as those develop, and as the world grows and everything, there should be higher and higher demand for copper from the current 30 million tons to 40 in 10 years, and then even beyond as the world grows and develops. Extremely positive tailwind for copper. And that's just one side of the story. The other side of the story is that there isn't that much copper easy to mine left, which means that at some point in time, without high incentives, without high copper prices, mine supply is going down, and then with higher demand, you have a supply gap that pushes prices higher. We can see here how there are some projects, but these projects will not add the 5 or 7 million ton expected, just 1.4, and here another 800 million tons. So not enough to cover the supply. You can see here also some of these companies are risky business on how much and for how long will they be adding copper supply to the field. So these brownfield expansions are a little bit longer term, but still just not even 1 million tons to supply, which leads to the long-term supply gap that will form likely. The expectations is that the issue will start in 2025, and then if you are invested in copper, you will do good. Thus, copper, the incentive prices, according to their calculations, is at least $5 per pound for new mines to be built and to cover for that increased demand. At $5 per pound, a lot of copper miners make a lot of money, and at the current copper price, no project is profitable. There are other issues, regulation, tax, licenses in most countries, ESG, and then also lower grades as the good copper has been mined already. And you can see here that in line with the projects, as it takes 10 years to develop a mine at least, then if you need to add 7 million tons over the next decade, the price, the incentive to do that is very, very high. And the fact is that for the last 7-8 years, miners have been underinvesting because they did overinvest in the past, and that led to low prices, that led to the recent underinvestments. And also natural things happen. Global copper grades are going down, which means that the cost of mining the tons of ore mined to obtain 1 ton of copper are going up and up, which increases the cost of production plus underinvestment. The equipment is aging, thus consuming more diesel, etc., which all leads to a structural deficit for copper. The world will need much more copper than we now perceive. CapEx is not reacting, no new projects as from 2025. Higher prices and a stable framework is needed to cater for the demand. There is a fundamental issue on the supply side. Also, from the grade perspective, from an environmental perspective, taxes and everything. So a lot of going on for copper in the long term. Now let's go to Bob Brackett from Bernstein. Amazing presentation, also a little bit more on when and how to invest, the timing of the cyclical investment thesis. So Bob Brackett, as I said, the outlook for oil will be then discussed in a different presentation. We also have EOG and many more interesting things. Of course, the thesis is there, industrial revolution based on fossil fuels. Now we are electricity based, and that requires miners and especially copper. If we look at what copper is used for, we have everything from construction, electrical, consumer, industry, renewables, EVs. Just now, in the future, that should be higher, but the problem is that the supply might not be enough and might not be there to cater for the demand. And if things are not changed, if there are no higher prices, there will be just a few more years for supplying that copper, and then a big supply gap will likely form if copper prices don't go up fast. But even if copper prices go up fast, you cannot ramp up a mine fast. It takes 5 to 10 years to ramp up and invest in a mine. So there might be great opportunities for copper investors. Just a note here, I'm looking at this chart. I have asked also oversupply for the next 4 years, especially if we have a recession, which means that it might still be a lot of fun in looking at copper prices and timing precisely these cycles. It's a very interesting long term, but maybe we are not yet there. We'll see. So this copper supply, if we look at it, scrap is pretty stable. There was also a question on that. So the long term, this is demand, and you know what happens to prices then and your investments. Very simple. If Tesla would hit their target of producing 20 million cars per year, this is a chart showing how much, as a percentage of global supply now, how much metals would Tesla need. 374% of lithium, 172% of cobalt, 142% of all the global supply of graphite, 33% of nickel, and 7% of copper. So insanity having such projections without the supply chains being there. And then also when it comes to projects, a lot of projects, Pebble and etc., Resolution, are questionable for the long term because of the huge ESG issues and everything. Plus, then you have taxes that change all the time that are detrimental to long-term investments, and those are all the issues that we have to keep in mind when it comes to investing in copper. Now comes the very interesting part for investors: when to invest, how much to invest, how to time these copper investments. And as an investor, especially the industry is focused on EBITDA, and you can see that EBITDA margins now are very high, have been declining a little bit, but also this is impacted by coal that has extremely high margins now because it was underinvested in the past, but still margins are on the higher bound here and not on the lower bound. And now you see these great businesses with high dividend yields, BHP 12% for example. So all looks great and you're very attracted as an investor. But let me show you the next chart. This chart shows how the return on investment, when the margins are low over the next 10 years, the return on investment is high. When the margins are high, as those are now, the return on investment is unfortunately extremely negative over the long term. So there is a great correlation there. So as Peter Lynch says, the best time to invest in cyclicals is when the situation looks and is bad and there can only be improvement in the future. If you do the opposite, when everything looks great, they are cash printing machines, then it's very likely that the long-term return will be negative because the future can only look worse. Of course, in the short term, it's a coin toss. It's very difficult to know. 1 year returns against EBITDA, it's a crazy scenario. So long-term returns are pretty clear, but here, every year you can make 80–90% on those returns, no matter the margins, but you can also lose 40–50% again, no matter the margin. So it's very difficult to predict in the short term, but in the long term, we must not forget that metals are usually predictable on the downside if you focus on the cash costs and when those hit the 90th percentile of cash costs. That usually balances the market. On inventory levels, of course, metals hate recessions, but the setup is not bad. As we have seen already, the inventory levels are extremely low. So Bob said that investing in copper is a coin toss now from that EBITDA perspective. The question he received at the conference was about how recycling might impact future supply. And he said that only 1/40th of copper returns into the economy, the rest goes lost, and that 1/40th in the economy that is then recycled, only 30% of that is economical to be recycled, the rest is stuck in something or so. So it will be a stable part of future supply, but that's it, just a stable part. To show it, you can see here the blue. It will likely increase over time, but don't expect miracles. Now let's discuss my opinion, my strategy, my actions. So if I look at the copper price, my bottom in 2016 and later was that, okay, at 250 it's very interesting to invest. 2 it's already a margin of safety. Now I'm changing that. I think that 250 now offers a margin of safety, and maybe at 3 we are already at very, very interesting solutions. However, the analysis that we made now is a top-down analysis, copper and the sector and the tailwinds and everything. I, as a value investor, I'm a bottom-up investor, so I will be going copper miner by copper miner, and then waiting for, okay, this is too much value, no matter what happens, recession lasts 9 years or something, and that's what I am looking for. Of course, this is what I do on my stock market research platform, these commodities, these metals, that are again an opportunity becoming now slowly. This is the core of my platform, so I will not be able to share everything on YouTube, of course, but I hope that this video already gives you a lot of value. So this tells me also that we will have volatile times ahead, especially if we have a recession on higher interest rates. Higher interest rates make your required return from investing in a mine at the beginning very much higher because you have debt payments and the bank doesn't wait. So that's also something to keep in mind when it comes to investing, and the investment cycle following this is extremely interesting over the long term. And then on the supply gap, also something to just keep in mind as very interesting. So they say now it will start forming 2029. Some say earlier, some say later, but I've been following copper for 7 years now, and this is, for example, a Freeport-McMoran presentation from 2014. You can still download this from Freeport-McMoran, and you can see here that they expected total copper consumption to go up significantly over the 10 years, as it is the expectation now, but they expected that also supply will go down if copper prices don't hit that a certain price. Of course, this didn't happen, and the chart was back then that there will already be a supply gap opening here, and that copper prices would be much, much higher over the long term. Of course, they are at 3 point something, but I'm still thinking as a risk, I have to be very careful also when investing. If this doesn't happen, who knows, you never know, I still want to do good, because if not, then I'm betting too much. So I'll be looking at the sector, miners, that's what I do bottom up, and then trying to find the best miners for different investment strategies to invest in. And I hope this video will help you do the same if you want to do it for your portfolio. The key takeaways is that I think we explained the risk and reward of investing in copper, the structural or tailwind that should help with the investments, the risks from financing, and you have to see how that fits your portfolio. When to buy? Well, when things look bad, when to sell when things look great, and what to expect from a return perspective. Thanks for watching. Check my other videos. Everything I do is in the link in the description below. Smash that like button. Many more commodities related videos coming, especially if these things keep crashing.